Alignment is not something you add to a trade after the entry. It is something that must already exist before you even consider participation. Most traders reverse this order. They enter first, then search for reasons to justify why they should stay. This is where imbalance begins. The moment you are in a position without alignment, you are emotionally invested. An emotional investment clouds judgment. Alignment must come before commitment. Otherwise, the trade owns you instead of you owning the trade. The market is always doing something, but it is not always offering opportunity. Understanding this difference is the foundation of survival. When price is moving in harmony across its structure, participation feels natural. There is no need to convince yourself. There is no need to force confidence. The trade either fits the environment or it does not. Alignment removes negotiation from the decision-making process. You are not debating whether to enter. You are simply responding to what is already present. Most traders believe alignment means agreement with direction. That is only partially true. True alignment means your timing, your risk, and your expectations are synchronized with current conditions. You may be correct about direction and still be completely misaligned. Entering too early, risking too much, or expecting too much are all forms of misalignment. The market punishes these mistakes quietly at first, then violently if they persist. When alignment exists, risk becomes honest. You know exactly where you are wrong, and you accept it without resistance. There is no hope involved. Hope is a signal that alignment is missing. A trader in alignment does not hope the market will behave. He knows how he will respond if it does not. This clarity creates calm. Calm creates consistency. Consistency is where results compound. Alignment also changes how losses are experienced. A loss taken in alignment does not damage confidence. It feels complete, contained, and acceptable. A loss taken without alignment lingers. It invites revenge, doubt, and overcorrection. The difference is not the size of the loss, but the state of mind in which it was taken. Before every trade, the question is not, can this make money? The question is, does this belong? Belonging is alignment. If the trade does not belong to current market conditions, no refinement will save it. The market does not reward effort spent on the wrong idea. It rewards patience applied to the right one. When you learn to require alignment before entry, trading becomes quieter. Fewer trades appear, but the ones that do require less management and less emotional energy. You stop chasing confirmation after the fact. You stop needing the market to prove you right. You are either aligned or you are not. And that single distinction, applied relentlessly, separates survival from struggle. Most traders believe a trend is something you identify with a line, an indicator, or a signal. They wait for a crossover, a break, or a pattern and call it direction. This approach treats trend as an event, something that suddenly appears and disappears. In reality, trend is a condition. It is an environment that either supports participation or rejects it. When you misunderstand this, you find yourself trading in places where the market has no intention of rewarding commitment. A trending condition is not defined by speed or distance. It is defined by order. Price respects structure. Pullbacks are contained. Progress is uneven but directional. When this order exists, the market is cooperative. When it does not, the market is defensive. Many traders lose not because they enter incorrectly, but because they trade aggressively in defensive environments. They expect reward where the market is only offering noise. Seeing trend as a condition changes how you behave. You stop asking whether the market will move and start asking whether the market is open to continuation. This shift removes urgency. You no longer feel the need to catch the beginning or the end. You are only interested in participation during the middle, where probability is most forgiving. Being late in a healthy trend is safer than being early in an uncertain one. When trend is treated as a condition, patience becomes logical instead of emotional. You are not waiting because you are afraid. You are waiting because the condition is incomplete. This distinction is critical. Fear-based waiting creates hesitation. Condition-based waiting creates discipline. The trader who understands this does not feel left behind. He feels protected. A condition also dictates risk. In a true trending environment, invalidation points are clear. Structure provides boundaries. Risk can be defined without imagination. In non-trending conditions, risk becomes subjective. Stops are based on comfort instead of logic. This is why losses feel heavier in choppy markets. They are not just financial losses. They are losses of clarity. Many traders try to force trend recognition by narrowing their view. They zoom in, searching for movement that resembles direction. But compression does not create trend. It only hides disorder. True trend is visible without effort. It does not require explanation. If you have to convince yourself that a trend exists, it does not. Understanding trend as a condition also reduces overtrading. You accept that some periods are designed for observation, not participation. You stop personalizing inactivity. The market is not ignoring you. It is simply not offering favorable conditions. Respecting this truth is an act of professionalism. When you align only with trending conditions, trading becomes selective by default. You participate less frequently, but with greater clarity and confidence. You stop fighting randomness and start cooperating with structure. The market does not move to provide opportunity. Opportunity exists only when the condition allows it. Recognizing this is not analysis, it is awareness. Most traders think patience is a personality trait. They believe some people are naturally patient and others are not. In trading, patience has nothing to do with temperament. It is a structural advantage created by clarity. When you know exactly what conditions you require, waiting is not a struggle. It is the natural state. Impatience only appears when rules are vague and expectations are undefined. The market continuously offers movement, but movement is not opportunity. Without patience, traders react to every fluctuation, mistaking activity for progress. This behavior creates exhaustion. Decisions pile on top of decisions, each one made with less clarity than the last. Patience interrupts this cycle. It restores distance between observation and action. In that distance, judgment improves. Patience is often misunderstood as passivity. In reality, it is preparation. The patient trader is not disengaged. He is alert, observing, measuring, and waiting for alignment to complete. This state requires more discipline than constant action. Clicking a button provides relief. Waiting provides growth. The market rewards the trader who can remain ready without being restless. When patience is present, emotions lose their leverage. Fear and greed thrive on urgency. They need immediacy to justify poor decisions. Patience removes urgency. It forces emotions to set before decisions are made. By the time a trade is taken, emotional pressure has already dissipated. This is why patient trades feel calmer even when risk is present. A lack of patience often reveals itself through early entries. Traders convince themselves they are being proactive, but they are simply uncomfortable with uncertainty. They want confirmation to arrive after entry, not before. This reversal creates stress. Being early demands hope. Hope is fragile. Patience replaces hope with structure. You wait until the market confirms its intent through behavior, not opinion. Patience also protects capital by reducing frequency. Not every session deserves participation. Not every setup deserves execution. The market does not pay for attendance, it pays for precision. By trading less, the patient trader exposes himself only when probability is favorable. This selectivity compounds over time, not through large wins, but through avoidance of unnecessary losses. Many traders fear patience because they equate it with missed opportunity. In reality, impatience creates missed opportunity by exhausting capital and confidence before conditions improve. The patient trader arrives intact when opportunity finally appears. He is not recovering. He is prepared. Patience is the bridge between analysis and execution. Without it, even correct analysis becomes dangerous. With it, simple analysis becomes powerful. Over time, patience reshapes identity. You stop seeing yourself as someone who needs to act. You become someone who waits for permission. And when the market finally gives it, execution becomes effortless. Risk must be defined before participation because once a position is taken, objectivity begins to fade. The moment money is exposed, emotion enters quietly and influences perception. Traders who attempt to define risk after entry are already negotiating from a compromised position. They adjust stops, rationalize losses, and reinterpret structure, all in an effort to avoid being wrong. This behavior is not strategic, it is defensive. Defining risk beforehand is not about minimizing loss. It is about understanding. A trader who knows exactly where his idea fails is free from internal conflict. There is no surprise when price moves against him. There is no emotional shock. The outcome has already been accepted. This acceptance removes fear, and without fear, discipline becomes natural rather than forced. Most traders underestimate how much uncertainty they can tolerate. They believe they are comfortable with risk until they are actually exposed to it. When risk is vague, every tick feels threatening. When risk is defined, fluctuation loses power. Price movement is no longer interpreted as danger, but as information. This shift changes behavior dramatically. Risk defined before participation also enforces proper position size. When the invalidation point is clear, size becomes a calculation, not a feeling. Many traders reverse this process. They choose size based on desire, then stretch risk to accommodate it. This guarantees emotional attachment. When size is appropriate, detachment is possible. Detachment is essential for consistent execution. A well-defined risk level acts as a filter. It forces selectivity. If risk cannot be defined clearly, the trade is not ready. This alone eliminates a large percentage of poor trades. Clarity becomes the entry requirement, not opportunity. The trader stops asking how much he can make and starts asking how much he is willing to lose. This reversal is where professionalism begins. When risk is defined first, exits become objective. There is no need for hope-based decisions. The market either respects the premise or it does not. Staying in a trade beyond invalidation is not patience, it is denial. Denial erodes trust in one's process. Trust, once damaged, is difficult to rebuild. Defined risk also stabilizes psychology over time. Losses no longer accumulate emotional weight. Each loss is complete. There is no residue. The trader does not carry frustration from one trade into the next. Emotional continuity remains intact. This stability allows probability to work as intended. Trading without predefined risk is an attempt to outsource responsibility to the market. Trading with predefined risk is an acceptance of responsibility. The market will do what it does. Your role is not to control outcome, but to control exposure. When exposure is controlled before entry, consistency becomes possible. Without it, every trade is a gamble, regardless of how refined the analysis appears. Most traders believe prediction is the core skill of trading. They spend years refining methods to anticipate where price will go next, convinced that accuracy is the path to profit. This belief creates pressure. Every trade becomes a test of intelligence, and every loss feels like personal failure. The market does not operate this way. It does not reward those who guess correctly most often. It rewards those who behave correctly most consistently. Process shifts focus away from outcome and toward execution. When a trader commits to process, he accepts that individual results are irrelevant. What matters is whether the trade was taken according to plan, under the right conditions with defined risk. This perspective removes emotional volatility. Wins do not inflate confidence, and losses do not destroy it. Stability emerges not from success, but from structure. Prediction narrows vision. It anchors the mind to a single outcome and filters information accordingly. When price behaves differently, the trader resists adaptation. Process, on the other hand, is flexible. It responds to what is happening, not what was expected. This responsiveness keeps the trader aligned even as conditions change. Many traders experience brief periods of success through prediction. They catch a move, feel validated, and increase size. When conditions shift, the same confidence becomes a liability. Process prevents this cycle. It does not allow emotion to scale risk. Position size, entries, and exits remain consistent regardless of recent outcomes. Consistency in behavior creates consistency in results over time. A process-based trader understands that losses are part of the design. They are not errors to be eliminated, but costs to be managed. Prediction tries to avoid loss. Process accepts it. This acceptance is liberating. The trader no longer fears being wrong. He fears being undisciplined. This is a healthier fear. Process also simplifies decision-making. Instead of evaluating endless possibilities, the trader evaluates compliance. Did the setup meet criteria? Was risk defined? Was size appropriate? If the answer is no, the trade does not exist. This simplicity reduces mental fatigue and overtrading. Over time, process builds trust. Trust in the method, trust in execution, trust in self. This trust is fragile when outcomes dominate focus. It strengthens when behavior remains consistent regardless of results. A trader who trusts his process does not chase recovery. He waits for opportunity. Prediction creates heroes and disasters. Process creates professionals. The professional does not need to be right today. He needs to be disciplined today. Tomorrow will take care of itself. When process becomes priority, profits stop being chased. They appear as a byproduct of correct behavior repeated under favorable conditions. Probability does not reward intensity. It rewards persistence. Most traders misunderstand this because they approach the market as a series of isolated events. Each trade feels decisive, final, and emotionally charged. When viewed this way, outcomes carry excessive weight. Probability only functions when trades are connected through consistent behavior over time. Without that continuity, randomness dominates experience. Letting probability work requires detachment from individual outcomes. A single trade proves nothing. A series executed with discipline reveals everything. Traders who constantly adjust methods after wins or losses reset the probability curve repeatedly. They never allow statistics to express themselves. Consistency is the gateway through which probability delivers results. Time is an ally only to those who behave consistently. The market does not reward patience once. It rewards patience applied again and again. This repetition is uncomfortable because it lacks drama. There are no sudden breakthroughs. Progress appears slow, and unremarkable. Yet this is how durable success is built. Many traders sabotage probability by increasing size emotionally. A loss, they attempt recovery. After a win, they attempt acceleration. Both actions distort statistical expectation. Probability assumes stable inputs. When inputs fluctuate, outcomes become unpredictable. Maintaining consistent risk allows probability to remain intact. Letting probability work also requires acceptance of variance. Losing streaks do not invalidate a sound process. Winning streaks do not confirm superiority. They are natural expressions of randomness within structure. The trader who understands this remains steady through both. Emotional neutrality preserves discipline, and discipline preserves probability. Time exposes behavior. Over a large sample, impatience is punished and restraint is rewarded. The market does not keep score daily. It accumulates results silently. Traders focused on short-term validation often abandon profitable behavior before it matures. They confuse discomfort with danger. Probability demands tolerance for uncertainty. The trader who aligns with probability stops seeking control. He does not attempt to force outcomes or accelerate results. He allows edge to unfold at its own pace. This surrender is not weakness. It is realism. The market cannot be commanded. It can only be approached with respect. When probability is allowed to operate uninterrupted, profits become inevitable, though never guaranteed in the short term. The trader's role is simple but demanding. Execute consistently, manage risk uniformly, and allow time to perform its function. Those who can do this stop chasing opportunity. They position to receive it.